Okay, so maybe I get started. All right, so I'm Rex, and okay, let me get familiar with this one. Okay, so I want to share with you guys the CFA talk. I know you guys probably know Power Career as well, and let me just share what I'm gonna cover today. So I'm gonna talk about like why picking CFA or sorry, let me quit my okay, so let me talk about the topic I'm going to cover today is why CFA and how to pass CFA, and then like some CFA question that in our interview, like I go through in the interview. My experience. So I work at Fund Data right after my master. So I did my undergrad in Farm in Waterloo, and then I went to Master Finance in Wolfrey Laurier. Right after Wolfrey Laurier, I went to Fund Data, mutual fund data company, and then I go to Manulife. Like I was in asset liability management department, and then I went into Invest Patrol, wealth management company, a small company that covered managed wealth for a high net worth individual, and I'm in the North American equity team. All right. So let's share, before I'm convince you to take CFA, let me share some things that I think you shouldn't do CFA because of these three reasons, okay? The first one, if you're thinking about, if you're not in finance, you're thinking about switching career to finance. Let's say you are in computer science or engineering, you can get it like right away, like through networking or MBA. That would be much more effective to getting a CFA into finance. Like passing CFA at least take you like 300 hours, right? But if you like me, you study finance, you already know, then yeah, like CFA, like passing CFA definitely help, right? So second reason, like you're not gonna become rich quick, right? Just because you finish CFA. At least I haven't seen any of my friends or colleagues who pass CFA and become rich right after, okay? Or you can look at who are rich around you and see whether they are having their CFA behind their name. Usually it's not, okay? The third one is if you're trying to like be better at investing, taking a CFA, you don't really need a CFA to invest, right? Like the goal, if you want to getting better at investing, like there's a much better way to do it. In my experience, like getting a CFA, it's just like a start. It's not really the end goal. There's like so much to learn about investment. For example, first you have to know like what's your goal and what's your preference, right? For example, if you invest for your retirement, you have like long horizon, right? You have 30 or 40 years to plan it out. Then you have to find out like what kind of investment type you are willing to do. Are you want to go passive or you want to go active, right? Like passive is probably save you a lot of time. Active is probably if you think you can beat the market or you kind of enjoy the investment process, so go with active. Let's say in the third step is if you decided to go active, like what path you're gonna become better, right? So what kind of books or material, company or industry you're gonna look into it. Let's say if you decide to go passive, like what plan or implementation plan strategy you're gonna take, like what ETF you're gonna follow. right? I'm gonna share more about investment next week, but we're gonna stick with CFA this week, okay? Right. So those are the 3 reasons not to take CFA. Let me share this is the 4 reasons I think why I taking CFA. Actually, I know about CFA because I went into FARM. FARM stands for Financial Analyst and Risk Management. That's one program in University of Waterloo. I was trying to decide whether I should go financial analysis and risk management. That's another path. After talking to the coordinator, he shared with me that if I don't want to be more quantitative, so quantitative probably should take risk size. Then CFA financial analysis is more help passing CFA. That's how I learned about CFA. Taking CFA definitely show your passion and seriousness about going to the finance field. Because if you're not serious about it, you won't commit your money and time into study, right? For this is very expensive exam. I'm not talking about the $1,000 registration fee. I'm talking about your time. If you're taking 300 hours to work, right? To work, not study. How much money do you think you can make out of that, right? So that's the opportunity cost you're foregoing, okay? The second reason is gaining credibility from people who know about CFA or took CFA before. So just give you a statistic. So there's 0.2 million people are taking them in 2019. So the past, I just rough estimation, right? So past 10 years, probably there's more than a million people that took the exam. And CFA is a global brand. For those who took it or becoming a charter, I become a charter in 2017. So you need 2 reference for you to become a charter holder, okay? And they know what you've been through, right? Each level take 300 hours, a lot of practice. You just forgo your summer. You have to study at home. That experience resonate. So they know, okay, so you at least know some finance. Okay. The third reason is it definitely help you to get a job. Help. It's not for sure, right? It's not guaranteed. It's always to get in order to get a job, working experience is always the most important one, right? And the second thing is the hard and soft skills. And then CFA or the education background. Those are nice to have, but that's not a requirement, right? And then the fourth reason is that's what I learned. It helped me to build understanding in the finance system. It's more like a map. Help you build up from there. Okay, so talking about this financial system, let's look at the level 3 material topic first, and then we go down to level 2 and level 1. Okay, so if we look at this level 3 topic, so the first one we see is ethical professional standards. That's the most important one. Why? If you look at it, each level has around 15% or 10% or 15% in there, because without ethical, without integrity, people won't trust money with you, right? Bernie Madoff, those are scam. People are trying to avoid, right? So having ethical, learning about ethical is important. I was learning about ethical by I'm thinking whether this decision I make or the multiple choice you did, okay, it's gonna make your mom proud, okay? if everyone knows the decision you're doing. But sometimes, like when you're doing question, it's kind of tricky. You have to know like what preference like a CFA guideline is asked you or require, or like it's good to have. Like you have to understand the difference. So ethical. So once you have the integrity, the second thing is economics, right? Economics, I have a link here. It's a Federal Reserve, the latest Federal Reserve report. It was around 140 page. But I listened to the Jerome Powell's talk during Wednesday afternoon. So this, like, once you understand the economic, it definitely help you to understand the macro, like what the Fed is doing, like why they are deciding not lowering or not increasing interest rate. On that day, the market go up a lot, right? 3%. Why is that? Maybe because the market was thinking the Fed may increasing rate right after the coronavirus is gonna getting better. But the Jerome Powell, the Fed chair, talking they're gonna keep the interest rate till 2022. So that may have an upside surprise, but it's really hard to tell. Like, but you kind of know like what is the long-term impact gonna be. When in 2000, like in March, like 3 months ago, the Fed decided to lower the interest rate to zero. Like, what is that going to do to the market, the stock market, right? Okay, after talking about the economic, we're talking about the portfolio management. That's the biggest change in level 3 compared to level 2 and level 1. So you see like level 1 is only 6%, level 2 is about 10% and 15% in portfolio management, wealth management, but in level 3 is 35 to 40%. That's very similar to what our firms do, invest virtual wealth management. We help individuals to build their wealth, right? And so we have to ask them, like, what's your goal, right? Those high net worth individuals, they may have they are retirement goal, or if they want to say it's not really retirement, they want to get a house, or they want to get a bigger house, right? So there's those are the goal. Once we get the goal, we know what is the required return, right? So there's a term called RRTTLLU. So what's that stand for? For those who are writing CFA level 3, very, very important because like there's huge chunk of materials going to cover in the morning section. So there are return, risk, taxes, and what is the other T? Time horizon, yes. And then the liquidity and legal, and then the last U is unique circumstance, right? So some people may say, okay, I don't want like anything related to gun or smoking, or I want all my portfolio a green portfolio. So those are the unique, or they want to donate some money like 10 years or 20 years later. Once we know about that, so that's the high net worth individual side. The other side is institutional. Institutional is talking about, so this is like we're giving a plan to who are we giving the plan to? One is individual, the other one is institution. Institution could be pension fund, right? Pension funds like Canadian Pension Plan or Ontario Teacher Pension Plan, right? So all of them plan. And also we have endowment, like we have Harvard endowment, we have Yale endowment. Those are one of the best endowment fund in the world. They have long horizon. They definitely have different goal, right? They manage the fund differently. So once we know who we are dealing with, what kind of constraint we are having, then we decided asset allocation wise which one to go with, right? Whether we should, how much we should put it into equity or fixed income and derivative and alternative investment. So if you're institutional, let's say like a Manulife insurance company, life insurance company, then they have a lot longer liability. For longer liability, you need to it's just your requirement, right? You have to invest more into fixed income to hedge your interest rate risk. I'm gonna share more about the interest rate, like fixed income question later on. There's some question I see I have during my interview. I can share with you guys. And also equity, there's a lot of intrinsic discounting cash flow, and we're trying to find out about what is the intrinsic value for the stocks we are considering, right? So we also I also gonna share some of those interview questions with you guys later on. And derivative, like for individual, probably the most that we use is probably option, stop option. We're using call or put to go long or go short with the company. It's very leveraged. And if you use it well, you can make money pretty quick, right? Because it's leverage, highly leveraged. But most of the time, options always expire, right? 90% of time, option expires. So if you don't know a derivative, like it's okay for individual investment to not touching any derivative. As an institutional or high net worth individual, when they're using derivative, it's more about hedging their risk. Like for example, if you're a founder, a CEO, right? You have a large portion of your wealth tied up to your company. And there's like a market risk, and you want to hedging your like a concentration risk you may like put by put in your company. So when that happened, or like that's individual cases, like in institutional cases, like for example, like institution also have similar concentration. They're not sure like if there's like an call coming. They are like, for example, this quarter, the coronavirus quarter, Canada Goose is closing all their store, right? So we're not sure whether the earning call is going to go well or go bust. So we decided, because we already have long position, let's talk about like whatever I'm talking about. I'm just giving an example. It's not investment advice, okay? We are trying to hedge downside risk so that we are buying put to cover it. Like let's say that if their earnings didn't do well, then the stock tanked, then our put value is going to increase dramatically. So that's going to cover our the holding loss, right? So we're going to sell it when we see it's reasonable. Then we cover our earning call risk, the event risk, right? So that's one. So derivative, they're speculation. You can speculate, but we're using a derivative more from a hedging perspective, okay? Even for insurance, there's a lot of derivative going on. For example, there are interest rate swap, cross-currency swap, because Manulife is also a global insurance. There's they invest into a lot of different currency in Hong Kong dollar, Japan dollar, AUD dollar, Canada, USD, even China. So they have to hedging all those risks, right? If they see their durations going long, they might using interest rate swap to shorten or lengthen their duration in order to match, right? The interest rate risk. We have a huge interest rate risk, like during the past quarter. We can talk more later on. in the alternative, like most of the alternative is real estate, private equity, farmland, oil and gas, commercial real estate, etc. Those are the assets that have a longer lifetime, right? And endowment love them, pension plan love them, Canadian pension plan love them, right? Because those usually because they're higher risk, so it's likely to have slightly higher return. But we, like, as an individual investor, most of us will buy our house or a condo in the future. That's probably the biggest asset in our balance sheet, right? In our individual balance sheet. So that's how I understand the entire CFA. So it's structured this way because it makes sense, right? So that's how when we manage like either individual or institutional, and then under the asset allocation, we're gonna allocate to equity or fixed income derivative or alternative investment, right? So, but before we're going to level 3, there's a lot of fundamental we have to know before we get there. So quantitative method, I remember was it's more like a statistic in your university courses. Economic, a lot of econ course. Financial reporting is the one. Financial report and analysis is the one that doesn't have it anymore in level 3, but is really important in level 2 and level 1. They have like very high percentage. There's a lot of things to remember. So what's GAAP? What's Canadian IFRS 7, IFRS, like International Financial Reporting Standard. So you have to know the difference. What is US GAAP? Like what is the expense compared to capitalize the return, right? So those are the things that it matters. Like why do I say it matters? When you analyzing a company, for example, Amazon, right? So we know Amazon, like it always have low net income, but why they have a lower net income? Because when they're doing research and development, when they develop a website, right? Even though this website is a long-term investment, like I would see it as long-term investment, but they're doing expenses. What do I mean by expenses? So there's a 2 treatment with R&D, research and development. Let's say $100. If I do expense, so that's gonna deduct from my net income right away, right? So if I doing capitalize it, so it's gonna expand it from my net income like through multiple years. So that would be huge difference. That's also another company, like all those like a software company like Shopify. They have a very low margin if you just by looking at their website like Morningstar. But if you actually change their financial report from research like expense to capitalize it, they immediately is going to show like at least 20% margin. So that's a huge, like 1% of margin can shift a lot. Okay. So that's the importance about financial reporting analysis. When you want to get into investment, you need the knowledge to build the financial modeling so that you know what the company is playing the game, and there's sometimes they're being really conservative. So that's the one thing, and I think level 1. When I first took level 1, the thing that I think I struggle the most is there's a lot of things I have to memorize it. So like a lot of this materials is actually covered in the university. So you see corporate finance is just like discounting cash flow, right? Net present value or like option value. Financial reporting analysis, that's just, it's different than the financial accounting course, but it definitely, financial accounting course in university definitely is going to help, but there's more. You have to know more the rule, the difference between US GAAP and then the IFRS, okay? Economic, there's more theory. So those theories, if you use it and you know it, memorize it, and when you're reading like Fed, when they're talking about it, like those are the theory actually the currently Federal Reserve are using it, like to set their policy rate, okay? Quantitative method, there's a lot of statistic, sampling, hypothesis. Yeah, I think this one is very easy to get high marks. I think derivative and this is hard. I think this two is harder, okay, to get high marks, but it should, yeah, relative speaking, like don't skip any material, right? Because you have to learn it to level 2 and level 3, especially level 1. Don't skip any topic, okay? All right, so let's go to the second part. Maybe just summarize it for the part 1. So like study CFA definitely helped me to build a financial system. Just by looking at it, it's still refreshed, right? So the reason the CFA structure this way, they have their reason because everyone's use it, right? If you get to the work, you know which part you are more interested in, and you can go to that area, okay? So when I was in fund data, it's probably more portfolio management or wealth management. And then my currently is probably more equity investment, I would say. And when I was in Manulife, it's more about fixed income and derivative. I don't have too much alternative investment, probably something that I'm looking for. The other one is it definitely going to help you get a job. It helped, right? It will gain credibility. It will also show, you can write it in your resume, right? You're passing CFA, you're taking your CFA level 1 or wherever your level is passing, okay? All right, so the second part, how to pass CFA. So when we're talking about passing CFA, let's say something that is stopping you from passing CFA, okay? Like start from 2 weeks before you're having the exam. It's like cramming the last day before exam. Some people can do it, but I wouldn't recommend you to go there. It's always better to over prepare because you only need pass, right? Otherwise, you're gonna waste $1,000 and 1 year, right? It's not worth it. And then you have to study for it another year. Trust me. So, and when you're reading the material, you're not really doing any question. I find, like, especially when I do the first, because when I preparing my CFA exam, I did multiple times. Like first time you forget so fast, right? It's like you never read it, right? It's frustrating. But when you're doing second time, you retain a little bit more, and then you're doing third time and keep doing question, and then you retain better and better. I mentioned the third one before. If you're skipping topics, like try to, like, unless you have no choice, okay? Try not to skip any topic, especially level 1. And then the fourth one is you never try mock exam. Like this, I would say this one is the most important one. If you don't have any time to do any of those 3, like you don't have time to go through every material, or let's say that you only have 2 weeks left, okay? What will I do, right? I'm not necessarily giving the advice for just like study for 2 weeks. Okay, let's say now I just facing the situation that I only have 2 weeks. Then what should I do? I would take mock exam, like to mock the whole day, and then try to compare my answer, and then to do wherever I think I know weakness. If you're weak every sector, I would pick the most high marked, right? If you're level 1, go for quantitative, economic, financial reporting, right? Equity, fixed income, right? So pick those highest one. The other one, you don't have time, so you have no choice. Then do those like question, memorize as many as possible. That's gonna help. But hopefully you don't need that. Okay. Let me talk about how to pass CFA. Okay. It was a long time ago when I did my CFA. I did it like 10 years ago. But if I have to do it again, here's the things that I'm gonna do. Okay. I'm gonna using the CFA textbook, and it's really thick. Like 6 book is higher than this my rice cooker, right? When I see it, I read it, I fall into sleep so quickly. So I'm not joking, it's true. So I get the Sweater note. Like Sweater note is more dense. Like the material is shorter, they summarize better. So that I was reading about their topics, example. Example is really important, and also practice question. I would focus more on example, because like example, you can read it and then understand what the material is trying to cover, and then you can try the example. Sometimes like you switch to other question, or you can do like the practice question. In the CFA textbook, I think I focus more CFA textbook in level 2 and level 3. The reason is Sweater note sometimes doesn't have as good example as the CFA textbook. Some of those like CFA end of chapter question is really good. So you see here in level 1, the mock, I will focus on the mock 2, the 2 mock exam. I think I found it. I think I get it. The Sweater, the mock exam. I just like pretend I was doing the actual exam and mock the whole day, and know my weakness, and then I come back, hit one by one, and then I passed the level 1. I was really happy and excited. It's great feeling. Feel like you're getting rewarded, right? But in level 2, I think is the time is more, the material is more, and then the time, I think my schedule is tighter, so that I run a little bit lower time. So I was facing the decision whether I need to, whether I should go or not. But I decided to, why not? Like I registered already, like why don't I give it a try? So I also did the mock exam to find out which one is my weakest point. I skipped topic here because I have no choice. I highly not recommend doing this, but that's the only choice I have. So I cover a lot of end of chapter question. So end of chapter question, sometime the first time when it's like reading a book, even though they're multiple choice, but understand completely. And then it's not about like quantitative, it's about qualitative, like how well you understand the material. I would rather understand one thing completely other than just skimming through for 10 questions. Okay. So level 3, I failed so many times. That's why I keep telling you guys, like money, time. I like, if I choosing this two, I always choosing like saving some time. Okay. So if you guys had the have the option to like find a wherever that can help you to pass all the CFA level at one try, go ahead. Like it's gonna save you so much time and you can do so much more with your 300 hours. All right. So with a lot of failing experience, if I'm gonna do it again, definitely I would focus completely in, let's say not completely, let's say if I have 300 hours, I would spend at least 100 hours in all those like past 10 years morning section exam. So those are the actual exam. The reason you do those, because those are actual exam. They're valuable, very valuable. So you can know not only what kind of topic they're covering, but also how they're testing it, how you're going to write the essay, like how do you get point, right? You want to do like at least 3 times for those. Like also CFA end of chapter question, very, very important. But like you see my sequence, right? I would go for the morning section if once I get those done, and then I go for the CFA end of chapter question. So those can help me to pass my get better for the multiple choice in the afternoon. Mock exam, definitely have to do mock exam, but not Swazzer note mock exam. Okay. But I think we don't have the multiple choice in the afternoon. So I was saving the latest, let's say if you're taking 2020, right? Then you're saving the 2019 one, the latest one, and then the 2018 one for my mock exam, so that I do more time. Okay. I would wait till the last month to start doing it. Like last month, you still have some time, right, to focus on those morning sections. Okay, so maybe just summarize it for the how to pass CFA test book for like Swazzer mock exam, very important for level 1. Level 2, end of chapter question, very important. Definitely mock exam is definitely you have to do it 1 month from the exam date. You get a feeling, right? You get a feeling how's your body feeling and time management, body management. And then like level 3, most important is get those 10 years past 10-year morning session exam. So we're gonna using the last bit of time to do some of the CFA question in my interview. Okay, the first part is more fixed income. So they will ask like, what's duration mean, right? If you know or you study the level 1, should be okay, right? Like all these questions should be okay. I can't remember where the emulation is, but yeah, like it's very easy to find it even just for Google. Okay, so duration. Let me find some of my prepared remarks. Okay, so duration means the size or the timing of the cash flow paid by a bond, right? So let's say a 10-year duration bond usually is around like 12 to 13 years bond maturity. Like it means every one basis point increase or decrease, the price is going to increase or decrease. Okay, so it's going opposite. Let's say the interest rate, let's say the Fed, right? The Fed lower 100 bips, right, in March. So the bond price is gonna increase so much, right? So the past 10 years, the interest rate being down for so dramatically, like from last 2008 was around 4%. Now look at it, it's like 0%, right? So the bond price actually, the bond we previously was using to get coupon, but now the capital appreciation did so much. So that's all about like the interest rate. So duration is actually cover the interest rate risk. Okay. The second question, which bond has a longer duration and why? Right. The first one is 5 years 1% coupon bond. The second one is 5 years 0 coupon bond. What do you guys think? Like, do you guys want to try it, like in the chatting box? I give you 5 seconds. 5, 4, 3, 2, 1. Okay, no one. I would answer myself. Okay. It's gonna be the 0 coupon bond because like all their maturity is gonna happen in 5 years, but 5 year 1 year percent coupon bond, like one of the 1 year coupon, so it happened like every year, this 1% coupon, right? So that is gonna lower the duration. So how we use it? What would 5-year duration bond price change if 50 basis point increase in interest rate risk, right? So that's the opposite. We mentioned a little bit in the first question. The duration is used to measure the interest rate risk, right? Let's say a 5-year duration bond, if they increasing 50 bips, we know that the price is definitely gonna going down, right? Interest rate go up, like bond price going down, right? And then if they go up by 15 bips, the calculation is more like 5 years, you have to times the bond price, right? Let's say $1,000 face value price, and then we times the 15 bips. 15 bips is around 0.15%, right? So you get around like what is that? 5. So that's around, I think it's around 10 or 70. Can't calculate everything in my head, but anything along that line. And then your price is gonna drop, right? So $1,000, you're gonna drop like, let's say $10. Okay, so that become $990 price. Okay. The fourth question is, if asset-based duration is 5-year, liability-based duration is 3 years, what would you recommend to do to close the gap? Okay, I guess like this question, in order to close the gap, we have to let's asking the fifth question first. Like, what is interest rate immunization? Interest rate immunization, what kind of strategy do you know? Like interest rate immunization, meaning that no matter how the interest rate gonna go up or down, right? So your asset and liability won't change, okay? I'll give you guys an example, right? If you're doing a mortgage, right? So you're getting a loan. That means you, like the bank is, this is an interesting example. I haven't thinking through, but let's just make it fun. So your mortgage, right? So you are bearing the interest rate risk. Let's say that if the interest rate going down and my mortgage is, let's say 2%, now the interest rate going down like to 1%. So if you're going out to the market to borrow the money right now, your cost is going to be lower. So your bond, you're going to suffer, but the bank is going to better, right? So it's like now if you're taking a loan from the bank, then the bank is an investor in your mortgage, okay? You are actually issuing the mortgage, all right? So the duration wise is like it flip. Right? So that is your liability duration. Let's say your liability duration is 3, and then your asset duration, let's say, what is your asset? Your house is your asset, right? Your house is long-term, okay? Then in order to get immunization, we can have 2 kind of strategy. One is the cash flow strategy. I think second one is the duration match strategy. So if that, we can answer in the 4 questions. So if our asset is 5 and liability 3, our asset is too long, right? So if the interest rate going up, our asset is going to drop more, right? So we are having an interest rate risk, right? So in order to do that, because usually we can't really change our liability, right? Our liability, it depends on who your liability is, right? If you sell insurance to product, then your liability is fixed, right? Let's say if a life insurance, that would be like any year from 30 years to 60 years, then you can't really change your liability. You can only lengthen your asset, right? But in this case, you have to shorten your asset-based duration. So what is the way that you can do it? Interest rate swap, right? You can get into like a pay lag, right? You can pay in fixed and receive flow, right? Paying fixed is always minus your duration, right? So that's one way. The other way is you sell your long asset and then you buy shorter asset, right? Okay, so that we cover the fixed income. This is more equity, right? Equity, I think this is more straightforward. Like for financial statement, that's very like usually people know 3, but we don't really know. We don't really using that much for the 4th one. The 3 one is income statement, financial statement. Income statement, balance sheet statement, a cash flow statement, and then the statement of equity shareholder, right? So the last one we don't using that much. If the second question is like, walk me through income statement. So like sometimes I got this kind of question, like walk me through income statement, balance sheet statement, or cash flow statement, right? So when you want to talk about it, you want to give them from the top to the bottom, right? So here's how I answer it, right? So the first line is income statement represent the revenue or sales, right? From there, we subtract the cost of the good, which give us the gross margin, right? And then we subtracting the operating expense from the gross margin. Like operating expense is what? Administration expense, selling and marketing expense, or research and development expense, right? All of them are operating expense. So that gives us operating income. Once we get the operating income, then we're subtracting. So that's our EBIT, right? EBIT, EBIT, right? It's also called operating income. Very important. Once we get that, we're gonna subtract our interest expense. Okay, when you have that, you have interest, right? You have to minus the interest. Like that's what the earnings before interest and tax. That's the EBIT. Once we minus that, we got our EBIT. So EBT. So that's earning before tax. After we taking tax or other expense. And then we can get our net income, the bottom line, right? Once we get our bottom line, we divide it by the number of share. We get our earning per share, right? So that's the second question. The third question is how the 3 main financial statement connected. This is a little bit tricky, but very popular question. So the way that I would answering is, so we know income statement, balance sheet statement, cash flow statement. When you're trying to building a financial modeling, you know you have to balance them and they have to adjust them, right? They have to link together. So usually we start from income statement, right? So, but when we talk about how to connect it, let me give you this way, okay? So the net income flow, so the bottom line of our net income, right? It flow into the cash flow operating, like the top of the cash flow statement, right? So, and then the net income minus the dividend give us the return earning. Return earning is from the, we're gonna add it to the balance sheet, to come up with the return earning on this period's balance sheet, right? So previous balance sheet return earning plus the net income minus the dividend, we get our this period's balance sheet. And then the beginning of the cash on the cash flow statement is the cash from the prior period of the balance sheet. I know you probably is a little bit don't know what I'm talking about. Maybe this one is more comprehensive, right? So we go from the net income, and then we come from all the way to here, right? That's how we connect it. Once we get our net income, so that's how we connect from the income statement to cash flow statement. And then I was talking about after the net income statement, take out the dividend, and then we got our return earnings, right? So the return earning, we're using the previous year's return earning plus the net income minus dividend, and then we get this year's return earnings, right? And then also the cash flow, like the beginning of the cash flow is a little bit below here. Beginning cash flow is adding all the cash flow down, and then we have the end of the cash flow, and then we put it down up here, right? So that's like a 3 simple way to connect income statement to cash flow statement and then to the balance sheet statement. Like there's a lot more connective, okay? Okay, let's talk about the 4th one. So if you could only choosing one statement to evaluate financial statement of a company, which one would you choose it, right? So I would choosing. I don't know whether there is a correct answer for this. I think it kind of depends, right? So if it's like a SaaS company, like for example Zoom, okay, or like Slack, or like a very high growth company, I think their income sales, or Tesla, right? Their sales is more important, right? Income statement probably is the one that I go with. But if it's more mature company, I would go with the cash flow statement, right? Because it actually show the liquidity of the cash. And then also, for example, like Hertz or like those bankruptcy statement, I definitely go with the cash flow statement, right? Even though they have all the balance sheet or like the cash or asset, if they short with cash, they can't really pay their debt. They are broke, right? So they have to went bankrupt. That's very key. And then the last one is walk me through a DCF model. A DCF model, we use it so many times. So you can see the first one is free cash flow. So how do we get free cash flow? Remember the EBIT, that's operating income, right? Multiply the 1 minus the tax rate, and then we'll plus back to so that's what we call the EBITDA, right? Add back the depreciation and amortization, and then we minus the capital expense and change in net working capital. Once we get all this, project all the 5 years free cash flow, and then we are getting the terminal growth multiple, and then we're trying to calculate what's the perpetuity free cash flow, perpetuity like a cash flow, and then we have to find out what is our WACC. Like what is a weighted average cost of capital, right? So we get this is the bond part. So this is the equity part, right? This is the preferred share part. Like some company don't have preferred share card. Then we get our WACC, and then when discount it all back, right? Then we have our enterprise value. So that's a very simple way to talk about it. I think that's it. Do you guys have that's all my sharing today. There's a lot, but do you guys have any question, or you can write it in the chat box or things. I'm going to share more about investment next week. I'm probably going to talk about if you decided to you can type your question, okay? I'm just share more what I'm going to talk about next week if you guys want to know more about investment. I think investments long it's a thing that everyone need to learn. It's not just CFA. I think investments are more broader. CFA definitely help us to get a job, but investment, everyone need to learn it. Yeah. Because using money to make money is a lot easier. As long as we know the way. You just like do whatever you want and then just sit there. Okay. Hi, sir. Do you think it's necessary to take both CFA and FRM exam? My experience, no, because both of them are more. Okay, let me put it this way. Okay, a lot of my colleagues have both. I think it's because they, what do I say? Because it depends on what kind of job you want to get. Okay, so CFA is more investment related, FRM is more risk related, right? If you want to go with investment, I think CFA is fine. Taking both doesn't hurt, but I think if you already have your CFA, adding FRM doesn't help that much. But if you have your FRM, you want a broader, like getting a CFA, probably help you to get better chance with the investment. That's how I see it. It's like accounting, right? People have their CPA and then they decided to go with CFA, right? I think CFA is broader, and FRM and CPA, those are more narrow, specific to the skill set. Yeah. So if we already have CFA, like I did consider about FRM, but when I was talking and asking around, I don't see a point, like in my cases, because I have my CFA, and then I was thinking about whether I should get FRM, and then I was asking around, and people say no, it's not going to help. Yeah, so I decided not to do it.